Hey everyone, welcome back to Corporate Decoder. Today, D.B.M.M Group just filed its Q3 10Q report for the quarter ending May 2026, and I am seeing a huge pivot toward AI that could change everything. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is betting big on artificial intelligence, and their future depends on it. So let's dive into what is going on with Digital Brand Media and Marketing Group, or DBMM Group as they're known. They've just dropped their quarterly report, and it tells a story of a company in the midst of a major transformation, a transformation heavily focused on artificial intelligence. Looking at their balance sheet, which is like a snapshot of what the company owns and owes, we see some interesting numbers. As of May 31, 2026, their total assets were about $62,000. That might sound small, but remember, this is a company focused on technology and marketing services, so their main value isn't in physical stuff. What is more telling is their liabilities, what they owe. They have over $9 million in current liabilities, meaning debts due soon, and almost $9.3 million in total liabilities. This shows they have significant debt. And get this, their total stockholders deficit is almost $9.2 million. A deficit means they owe more than they own, which is a tough spot to be in. But it also tells us they are heavily reliant on some form of capital infusion or debt to keep going. Now, let's look at how they performed financially. For the 3 months ending May 31, 2026, their revenues were about $48,600. That is a decent jump from just over $25,000 in the same period last year. For the 9-month period, revenues were around $134,000, up from about $81,000. So their top line, the money they're bringing in through sales, is growing. However, even with growing revenues, they are still reporting operating losses. For the 3-month period, the operating loss was nearly $114,000, and for the 9-month period, it was over $383,000. They are spending more to run the business than they are earning from it right now. And when we look at net loss per S-hair, it is a penny or less. This isn't surprising given the overall losses, but it highlights the challenge of turning a profit. The cash flow statement is where we see how much cash is actually moving in and out of the company. For the 9-month period ending May 31, 2026, they used over $457,000 in operating activities. This means their day-to-day business operations are draining cash. They did bring in over $459,000 from financing activities, which is mostly from borrowing money or issuing debt. This helped offset some of the cash drain, but it's not a sustainable solution in the long run. This section really spells out the company's situation. They're preparing their financial statements on a going concern basis, which is standard, but they immediately follow up by saying they don't have enough cash to cover their outstanding loans and convertible notes, which add up to about $4.5 million. This raises serious doubts about their ability to continue operating. However, they do mention a non-binding commitment letter for $250,000 and the possibility of raising up to $3 million more. This is the classic balancing act of a company trying to secure funding to stay afloat. Here they lay out their accounting rules. They consolidate their subsidiary, Styler Limited, and mention that cash equivalents are things that mature in 3 months or less. They also state they had no cash equivalents as of May 2026. Meaning all their cash is just sitting in checking accounts. Interestingly, their advertising costs were actually higher in 2025 than in 2026 for the 3-month period. This might seem counterintuitive for a company pushing a new AI strategy, but it could also mean they are being more strategic with their ad spend, focusing on areas with higher potential returns. This part talks about how they calculate earnings per S-hair. Basic earnings per S-hair is the standard calculation, but here they say diluted earnings per S-hair is not presented separately because it is anti-dilutive. This means that if they accounted for all the potential shares from things like convertible notes, it would actually make their earnings per S-hair look worse. They mention a significant number of potential shares from convertible notes that could be issued. This is a really important section for understanding the company's financial risks. They account for certain financial instruments that derive their value from other assets, like convertible notes that can turn into stock. These are classified as liabilities and they can fluctuate in value. The change in fair value of these liabilities is impacting their income statement. They use complex models to value these, and any shift in assumptions or market conditions can lead to gains or losses. They mention that their derivative liabilities are valued using level 3 inputs. This means they rely on unobservable inputs, which involves a lot of estimation and can be less reliable than using readily available market prices. This adds another layer of uncertainty to their financial picture. They discuss how they handle convertible instruments, which are basically loans that can be converted into stock. They have to evaluate these carefully to see if parts of them should be treated as separate financial derivatives. Here we see what makes up their accounts payable and accrued expenses. A big chunk is accrued interest at over $2.1 million. This indicates a substantial amount of debt on which interest is accumulating. They also have a significant amount for carrying value of shares issuable, which suggests they owe shares as part of settlements or obligations. Their loans payable stand at over $4.2 million. They mention these are generally due on demand and are unsecured. The maturity schedule shows the entire amount is due within the next 12 months. This highlights an immediate need to either repay this debt or refinance it. These convertible debentures are old, maturing in 2015, and the company hasn't issued any new ones since 2015. They say certain settlements have been agreed upon to the company's benefit. This suggests they are working to resolve these old debts. This table gives us a peek into how they value these complex derivative liabilities. The numbers for effective exercise price and effective market price, along with volatility, show how much these valuations can change based on the company's stock price and market conditions. The significant change in volatility from 18% in 2025 to 63% in 2026 suggests a lot more uncertainty and potential for dramatic swings in the value of these liabilities. This breaks down their stock structure. They have Series 1 preferred stock with some voting rights and Series 2 without. What's notable is the authorized number of common shares, which is 2 billion. As of July 2026, they had over 865 million shares outstanding, which is a huge number and hints at quite a bit of dilution over time. Linda Perry has an annual compensation of $150,000 as a consultant and executive director. This highlights a key leadership role focused on external reporting and funding. Here's where it gets interesting. This section breaks down their revenue and assets by geography. What really stands out is that 3 of their customers accounted for 100% of their accounts receivable and 100% of their revenues in the 3-month periods of both 2025 and 2026. This extreme customer concentration is a major risk. If even one of these 3 customers leaves, it could devastate their revenue. This note describes a significant event in 2025 where they settled convertible debentures by issuing 100 million shares of common stock. This generated a gain of over $459,000. While this settled debt, the issuance of so many shares likely had a dilutive effect on existing shareholders. This is the management's own story of what is happening. They talk about recovery from COVID, inflation, and longer sales cycles. They mention their operating business, Digital Clarity, has historically been cash flow positive, but the costs of being a public company eat up profits. Their strategy clearly involves a significant shift to an AI, Augmented GTM Consultancy. GTM stands for Go to Market, essentially how they plan to sell their services and products. They frame 2025 as a year of getting their house in order, investing in their future, and strategically repositioning from a marketing agency to an AI consultancy. They highlight the Digital Clarity Intelligence Engine, or DCIE, their proprietary AI platform. Management believes they are entering a growth and commercialization cycle. Their forward-looking strategy for 2026 to 2027 includes accelerating the DCIE roadmap, expanding their consulting services, and diversifying revenue by introducing subscription and licensing models for DCIE. This section really details their AI strategy. They state that AI is no longer optional. It is a critical imperative for competitiveness. They are blending consulting with AI-powered execution and developing the DCIE platform. They cite market research showing massive growth in AI adoption and spending. Here is the heart of their AI bet. The DCIE is described as an integrated suite of modules for B2B technology marketing. They mention modules like the Insight Engine Optimization, Strategic Navigator Suite, and Data Qualification and Alignment Framework. They also emphasize its hybrid architecture, using both public and private AI models for security and cutting-edge capabilities. This proprietary technology is seen as their major differentiator. They are also developing the Digital Clarity Investment Intelligence Platform, or DCIIP, to provide go-to-market audit capabilities for venture capital and private equity firms. This is an interesting niche. targeting investors who need to assess a company's sales and marketing readiness before investing. Once fully deployed, DCIE is expected to convert consulting expertise into a scalable digital asset, provide predictive and generative capabilities, enable recurring software revenue, and strengthen their competitive advantage. They list some impressive clients like Adobe Workfront and Xerox, and highlight successful outcomes like significant revenue growth for their clients. This shows they have a track record of delivering results, which adds credibility to their new AI-focused approach. They're aligning themselves with major market trends, pointing to significant growth in digital transformation and AI-enabled revenue intelligence. They see a market opportunity of around $100 billion for GTM management consulting. They position themselves against large consultancies, boutique firms, and MarTech platforms. Their differentiation comes from their proprietary AI technology, DCII, combined with deep consulting expertise. They call it a consultancy with technology model. They see the US as a primary market for AI consulting and plan to expand their presence there, leveraging client proximity, the investment ecosystem, and access to talent. This section sums up their unique strengths: proprietary technology, DCIE, a hybrid business model blending consulting and software, market focus on B2B tech, and strong leadership. They're actively working to increase investor visibility through conferences and online content, aiming to build confidence and attract investment. Management details the challenges of 2025, including economic headwinds, shrinking marketing budgets, and longer sales cycles. They admit revenues declined, but stress this was partly due to a deliberate shift away from commoditized services to focus on higher value consulting and DCI development. They use this difficult period to pivot and invest in transformational change. They explain that revenue declined because they consciously exited or reduced low margin, commoditized services like pay-per-click management and SEO. They also faced longer sales cycles, meaning deals took more time to close. Most importantly, they intentionally redirected resources to develop the DCIE platform, viewing it as essential for their future. They gained clarity on market needs through client conversations, identifying pain points like the gap between strategic advice and execution capacity, data overload without actionable intelligence, the need for speed with quality, and the demand for clear ROI. These insights shape DCIE's design. DCIE is described as the codification of their decades of consulting experience into AI-powered modules. It is not just a branded platform, it is truly proprietary intellectual property. DCIE is designed to be a standalone revenue generator. They plan to offer direct licensing, white label partnerships, and a subscription-based SaaS model. This transition to recurring revenue is key to their future valuation and stability. They project a minimum of $1.2 million in revenue for fiscal 2026, a significant jump from 2025. This projection is driven by the commercial launch of DCIE, conversions of pilot clients, the introduction of subscription revenue, and initial white label partnerships. They lay out a detailed revenue trajectory for fiscal 2026, with Q1 focusing on DCIE launch and pilot conversions, Q2 on subscription model introduction, Q3 on investor GTM audit services gaining traction, and Q4 on fully realizing recurring revenue. They aim for EBITDA break even in fiscal 2027. They expect gross margin expansion due to DCIE's premium pricing and automation, operating leverage from their platform approach, and predictable revenue from subscriptions. The key investment thesis is that DCIE positions them at the intersection of AI adoption, the shift from commoditized services to strategic platforms, and the demand for revenue intelligence. DCIE creates defensible advantages through proprietary technology, data network effects, a hybrid expertise model, and a first-mover advantage in their niche. They see multiple ways to create shareholder value: organic growth, strategic partnerships, platform licensing, and even the potential for strategic acquisition or a spin out of DCIE. They've actively worked to eliminate old debt, particularly convertible debentures, by renegotiating terms and settling with cash or a fixed number of shares. This is a responsible move to clean up their balance sheet. They highlight their cash position of just $25,000 and a working capital deficiency of about $9.2 million at May 31, 2026. They use $457,000 in operating activities, largely due to a net loss and shortfalls in liquidity. In the prior year, their cash was even lower at $20,000, with a working capital deficiency of about $7.8 million. They used $409,000 in operating activities. A gain on derecognition of liabilities helped offset some of this. Looking at the numbers side by side, revenues significantly increased in both periods, up 94% for the 3-month period and 64% for the 9-month period. Cost of revenues also rose, but at a slightly lower rate, indicating some gross margin improvement. However, sales, general, and administrative expenses also increased, leading to a larger operating loss in dollar terms for the 3-month period. The net loss widened by 30% for the 3-month period, and the 9-month period saw a huge increase in net loss, nearly doubling. So while revenues are growing, their losses are also growing largely due to increased interest expenses and the absence of the gain on derecognition of liabilities seen in the prior year. They use adjusted EBITDA as a metric to show their core operational performance, removing interest, taxes, and other non-cash items. While this can be useful, it is important to remember that it is not a GAAP measure and should be viewed alongside their actual GAAP results. As a smaller reporting company, they are not required to provide this detailed market risk disclosure. Management has evaluated their disclosure controls and procedures and concluded they are effective. There were no significant changes in internal controls over financial reporting during the quarter. This section covers legal proceedings, risk factors, unregistered sales of equity securities, defaults upon senior securities, and other miscellaneous items. They state they are not required to provide detailed risk factors as a smaller reporting company, and that there are no unregistered sales of equity or defaults. This lists the exhibits attached to the filing, including certifications from their principal executive and financial officers and XBRL files for interactive data. Finally, the report is signed by Linda Perry as Principal Executive Officer, Principal Financial Officer, and Executive Director, certifying to the accuracy of the filing. Alright, looking at D.B.M.M Group, their big story is the all-in bet on AI with their DCI platform. They've recognized that the old way of doing marketing consulting is becoming commoditized, and they're betting that AI is the future. The financials show this is a company in transition. Revenues are growing, which is positive, but they are still unprofitable and have significant debt. Their customer concentration is a major red flag, with 100% of their revenue coming from just 3 clients. The risk I am watching is whether they can successfully monetize their DCII platform and attract new customers beyond those 3. If DCII can deliver on its promise and they can diversify their client base, their future could look very different. But right now, it's a high-stakes gamble on AI. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord community. All linked below.